So over the last few weeks, I've been conducting in-depth research on the company Texas Instruments. And what really stood out to me in all of the research that I conducted was how strong their management team was. Now, are they the best management team for any company trading on the stock market today? Probably not. But they serve as a great example for what it means to have strong management driving a very strong company. And in fact, strong management is what separates a temporary investment to a forever hold for legendary investor Warren Buffett. If he can trust the management to continue producing value for shareholders in the long run, that is what separates companies that he's going to be making a temporary investment in versus the ones that he's going to be holding forever. So for that reason, I thought it would be a very useful video for you all to go over what it means to have strong management driving a company. For a quick breakdown of what we're going to be covering in this video, I'm going to start us off by taking a look at all of the factors that make up a good management team. Most investors, when they're making an investment decision, are primarily focused on the business itself and how good the financials of the company looks, and most people neglect how good the management is. So for that reason, I think it's very important to learn about what it means to have good management running a company. And after we've looked at all of these factors, we're going to move into looking at how Texas Instruments management team has applied all of these factors to Texas Instruments business in order to become one of the strongest management teams on the stock market today. Now, as always, I'd love to hear your comments in the comment section down below. And if any of you would like to skip ahead to a certain section in the video, you can find the timestamps for every section in the description down below. So with that, let's get into it. Alright, so when it comes to assessing whether a company has strong management, there are two primary factors that we want to look out for. The first is how good of capital allocators is the company's management. Now, what I'm talking about when I say capital allocators is what is the company doing with the cash that the business is producing. Now, there's a few metrics that we can look for in order to assess how good of capital allocators a company is, and we're going to be talking about that in this video. The second factor you want to look out for is has the management aligned the goals of the employees and the management team with that of the shareholders. At the end of the day, you want management to be chasing the same goals as you as a shareholder in order to maximize value for you. So this one is a little bit tougher to figure out, so I'm going to be providing you all with some points on what to be looking out for to give you hints that the management has been aligning the goals of the employees and management team with you as a shareholder. So of the two factors, the most important one is how good of capital allocators is the company's management. And the reason why is because management can align the goals of the employees and the management team with you as a shareholder, but if they don't know what to do with the cash that the business is generating, that really doesn't mean anything for you. So what you really want to find when you're looking for good management teams is effective capital allocators. And now that's exactly what we're going to jump into right now as we look at all of the options a company has when it comes to spending the cash that the business has produced. Now, the most important metric to use when assessing whether a management team are effective capital allocators is by comparing the return on invested capital to the weighted average cost of capital for the company. You can think of the weighted average cost of capital as what it costs the company to fund its operations, and you can think of the return on invested capital as what the company is producing from its operations. Now, you want to see a return on invested capital higher than the weighted average cost of capital. If a company has a return on invested capital, or ROIC, higher than its WACC, then that means that the company is actively driving value for you as a shareholder because their operations are bringing in more cash than they have to dish out in order to fund their operations. However, if you see a company with a return on invested capital less than the weighted average cost of capital, that means that the company is actively destroying value for you as a shareholder. Now, this is especially true when the company is growing. If a company is growing its revenues and it has a return on invested capital less than its weighted average cost of capital, that means that they are actively destroying value for you as a shareholder because they are paying more to grow than the business is actually producing. So you want to make sure that a management team has a return on invested capital higher than the weighted average cost of capital. Now, the higher the return on invested capital, the better. And this is how you can really tell if a management is very good at investing in the right projects for the company. Now, when it comes to how the company is using the cash that the business is generating, there are four primary things that a company can do. The first one, which is the one that you want to make sure the management is not doing, is just building up their cash reserves with no apparent reason in mind. They're just building up their cash because they don't know what to do with it. This is very bad for you as a shareholder because it's not doing anything for you. And in fact, if the company isn't invested in inflation protected securities, that cash pile is just becoming more and more worthless every single year. So you want to make sure that a company is not just building up its cash reserves for no reason at all. The second thing that a company can do is redistribute that cash to you as a shareholder through either a dividend or through share repurchases. This is very positive, and you'll see a lot of companies doing this with their excess cash. They're going to redistribute it back to you through dividends or share repurchases, and that's how they're going to be driving value for you as a shareholder. The third thing that a company can be doing is investing in the organic growth of the business. Now, investing in the organic growth of the business is essentially through their capital expenditures, where they're going to be buying new machinery or expanding their production capabilities. Anything that is going to be increasing the productive capabilities of the business is considered investment in the organic growth of the company. And this again is very positive as long as the return on invested capital of these expenditures is higher than the weighted average cost of capital. Because as we said, if they're investing in projects that are returning less than they are costing them, that is destroying value for you as a shareholder. Now, the fourth and final thing that a company can do with their cash is to acquire other companies. And again, if they're going to be acquiring companies, you have to be very careful that they're acquiring companies that have a return on invested capital higher than the weighted average cost of capital of the company doing the acquiring. A lot of the time, this is why larger companies are able to acquire smaller ones, because the large company has a weighted average cost of capital far lower than the smaller one, so they're able to basically just absorb the smaller company and have a return on invested capital that is higher than their weighted average cost of capital, whereas that might not have been true for the smaller company when it was operating on its own. So again, a lot of this comes back to having a return on invested capital higher than the weighted average cost of capital, and that is why it is the most important metric to be looking out for when you're assessing how effective the management team is. So those are the three things that you want to make sure that management is doing. You want to see that they're either redistributing their excess cash back to you as a shareholder. You want to see them investing in the organic growth of the company. And for some companies, you want to see that they're acquiring companies that have a return on invested capital lower than the weighted average cost of capital. So those are the primary ways that you can tell whether a management team are effective capital allocators. And now moving into the second factor, which is seeing whether management has aligned the goals of the management team and employees with that of the shareholders. Now, the primary way you can tell if they have done this is if the employees as well as the management team have a lot of exposure to stock in the company. You can tell by looking at the employee share plans that the company has offered, and you can also see by looking at how much of the management's compensation is stock-based. If management also has a lot of their compensation coming from stock, that means that they're also going to be operating in the best interest of the stock price, since that is where they're going to be getting their income from. So basically what you want to look for is management that is thinking like owners rather than as employees. And generally the way that this happens is by the employees or the management team having a lot of exposure to stock in the company. So those are the two factors that you should always be looking for when trying to assess whether a management team is good. And now let's move into Texas Instruments to look at how their management team has done over the last 10 years, so you can see exactly what it means to be a strong management team. All right, so Texas Instruments management team does a lot of things that makes them such an excellent management team. They have four primary vehicles through which they drive value for you as a shareholder, and we're going to start with the one that has received the most cash in the last 10 years. In the last 10 years, TI has invested $31 billion into the organic growth of the company. Now, they have spent this on things like R&D and additional manufacturing capabilities, and this is what I'm talking about when we were talking earlier about investing in the organic growth of the company, as this is what is going to be driving value for you as a shareholder as the company is able to produce more cash flows. Now, these investments in organic growth have paid off in a massive way for Texas Instruments, as a return on invested capital is 20%. Now you get an idea of just how remarkable that return on invested capital is when you look at the WACC, which is just 4.2%. So the company is producing cash hand over fist compared to how much it costs the company to run its operations. So this means that the company is extremely effective and efficient at investing in the organic growth of the company. And now the way that they have done this over the last decade is that they've slowly shifted their focus away from the wireless segment of their business towards the analog chip segment of their business. Now, I'm not going to get too into the nitty-gritty of their business model, but essentially what they did is they slowly divested from a portion of their business that was producing lower margins and had much more competition into a segment of the industry that didn't have as much competition and that had very high margins. So that means that the management is very smart and they knew exactly where they should be placing their money over the next decade in order to be producing the most value for you as a shareholder. Now, if you look at the revenues, they haven't really grown that much. They've achieved a CAGR of 3% over the last decade, which is pretty much right on par with US GDP. It's nothing crazy, and just looking at that, you might say that the company hasn't done very well. However, if you look at their free cash flows, they have grown at a compound annual growth rate of 11% over the last decade and a compound annual growth rate of over 10% in the last 5 years. This is absolutely remarkable growth in free cash flows, and it shows you just how effective those investments in organic growth have been for the company, as they've been able to grow their free cash flows at a far more rapid pace than their growth in revenues, primarily driven by the increased margins of the investments the company has made in the analog segment of the business. If we look at a segment breakdown of the company's revenues, we'll see that the analog segment went from representing 30 to 40% of revenues in the early stages of the decade to representing over 70% of the company's revenues by 2019. This highlights just how much the management has been focused on growing the analog segment of the business, and you can see how successful that shift in focus was by seeing how much the free cash flows have grown compared to the revenues of the business as a whole. Now, the second and third vehicles that have received the most cash for the company's capital allocation strategy are redistributions to shareholders. They are one of very few companies that have grown their dividend for 16 years consecutively. The value of their dividends paid have grown at a compound annual growth rate of 18% over the last decade, and it makes them part of an exclusive group of stocks that a lot of people like to refer to as dividend aristocrats, which are basically companies that have never cut or delayed their dividend and have consistently grown their dividend for an extended period of time. In addition to that, they have consistently been reducing the numbers of shares outstanding by conducting share repurchases. The number of shares outstanding have declined at a compound annual growth rate of negative 2.89%, and whatever money the company doesn't spend on dividends from their free cash flows, they put into share repurchases. So over the last decade, the company has returned an average of 107% of free cash flows back to shareholders through dividends or through share repurchases. Now, this also comes after the investment in organic growth that the company has been doing over the last decade as well. So while the company is investing in organic growth that is increasing the free cash flows for the company, they're then redistributing those cash flows to you as shareholders. And this is what makes them such effective capital allocators, that they're able to both organically grow the business with a return on invested capital that way outweighs their weighted average cost of capital, and redistribute all the cash that they're getting from those investment activities back to you as shareholders. Now, the fourth and final capital allocation vehicle that the company has been using over the last decade is acquisitions. Now, the company has a past of conducting a lot of acquisitions, but in the last decade, they've only done one. And that was of National Semiconductor, which they had completed the acquisition of in 2011. And this was part of their investment in the analog segment of the industry, which National Semiconductor had a large portfolio of analog chip products. Now, National Semiconductor had a return on invested capital of 20% in 2011. So Texas Instruments saw that National Semiconductor had a very solid return on invested capital. They purchased the company, and it helped Texas Instruments grow their market share in the analog segment, as now Texas Instruments has the highest market share in the analog chip segment of the semiconductor industry, and it gives them a lot of power within the market. So through these four vehicles, Texas Instruments has proven to be one of the most effective capital allocators in the stock market, and I think that they are a perfect example of what it means to have a strong management team running the company. So for a quick recap, the company has spent $31 billion on the organic growth of the company in the last decade. They have spent $27 billion on share repurchases. They have spent $16 billion on dividends, and they have spent $7 billion on acquisitions. So all of this builds into an exceptionally effective capital allocation strategy and is a perfect example of what you should be looking for in companies that are effective capital allocators. We want to see them investing in projects that are going to be producing higher returns on invested capital than the weighted average cost of capital. And you want to see them redistributing any excess cash that they don't need to you as shareholders. Now, a company with such a great capital allocation strategy is very happy to share it with all of us. So I also will include it in the description down below, a link to a short overview, just around 2-3 pages of the company's capital allocation strategy in case you are interested in hearing it from management's mouth themselves. And in addition to that, the company has taken a lot of steps in order to ensure that the management and employees are thinking and acting like owners. A lot of that comes from management having a lot of exposure to the company's stock, and also has a lot to do with how the management has structured the culture at Texas Instruments. So I hope you enjoyed this video, and I hope you learned something new that you'll be able to apply in the future when you're looking at assessing a company's management team. I hope that I gave you some useful tools that you'll be able to apply in the future, and I look forward to seeing you all in my next video. Have a great week.